Good afternoon, everyone, and thank you for joining us for today's professional education event entitled Top Ideas and Considerations, Long-Term Care Insurance and Your Retirement Plan. This session is being hosted by CBM, MBI, and Karp Loshak LTC Insurance Solutions. And our presenters today are Aleksandr Seleznev of CBM and MBI, and Natalie Karp and Rona Loshak of Karp Loshak LTC Insurance Solutions. Today's session will have CBM's typical hour of programming, but we may add an additional optional 15 minutes for Q&A based on the amount of content that we have to cover. And for any guests that are interested in attending, we will also have an open dialogue with Natalie and Rona after the session. So I'll open people's mics if you'd like to have more of an ongoing dialogue. Aleksandr Seleznev is a partner, senior advisor, and portfolio strategist at CBM and MBI, the firm's financial advisory subsidiary. He's a certified financial planner and a chartered financial analyst who leads the firm's investment management division. Alex's professional focus is on comprehensive financial planning and investment management. He is a regular presenter for CBM, and in addition to today's session, he is scheduled to co-present in a November 2nd session entitled Grow Your Net Worth, Top Strategies for Retirement and Post-Career Planning, and on December 6th in the first of CBM's year-end tax planning webinars for businesses and individuals. Alex will provide a market update during that session. He was quoted in April in a Kiplinger's article about searching for yields in a low-yield market. Natalie Karp and Rona Loshak are highly accredited, award-winning specialists in long-term care insurance. They are Goldman Sachs 10,000 Small Business Long Island Achievers honorees and are recognized by the American Association of Long-Term Care Insurers as top professionals. They navigate the LTC marketplace to optimize successful outcomes and confident decisions, and are a trusted source of information on long-term care insurance that includes traditional, standalone insurance, asset-based and hybrid LTC, and life insurance using LTC riders to create customized plan designs and maximize financing options for tax and estate advantages. Natalie and Rona are well regarded for their educational platform and consultative approach, recognized by national and local media, recipients of citations and congressional recognition. Karp Loshak LTC Insurance Solutions is a trusted resource for consumers and professional advisors. In a moment, I will be reading some learning objectives to just let everyone on the webinar know what the educational goals are for this session. The session is being recorded, and if you have any questions during the webinar, please enter them in the chat box or wait until the end of the session to be unmuted. If you asked questions during the registration process, those have been shared with our presenters. Also, we will be offering continuing professional education credit, so we will be launching a series of polls. I will launch a sample poll now, and so you will see 4 polls throughout the session. The poll will either appear on the meeting screen or in the chat box. You only need to respond in one location. Don't worry if it appears in 2 locations. So this is what the poll is going to look like. There will be 4 of them. Please respond to at least 3 if you are interested in receiving CPE credit. If you are not interested in CPE, don't worry about it. You can disregard that part of the program, and a certificate will be issued to everyone who qualifies after the fact. Natalie, if you wouldn't mind advancing to slide 3. I think to save time, I will just show the learning objectives. So this is what we intend to share with you today. And with that, I'm going to turn it out now over to Alex.
Next slide, please. Thank you, Joe, and thank you everyone for joining us today. I will apologize for my scratchy voice. I lost it yesterday. Hopefully I'll regain it at some point this weekend. And of course, those of you who know me, I usually sound much better than this. So anyways, before we get started, just a little bit about MBI. Perhaps for some of you who are less familiar with what we do, we're a subsidiary of CBM. We're a fee-only comprehensive financial planning and investment advisory group. To say it differently, we're fully independent, and we always serve as a fiduciary when we work with our clients. And that basically means that any recommendations that we prepare, they have to be in their best interest, which of course eliminates many potential conflicts of interest. In terms of our team, we have 7 professionals dedicated to this work. We have 5 chartered certified financial planners. We have 2 chartered financial analysts, And we're actually hoping to add one more to our team soon. And of course, as part of CBM, we have access to more than 40 CPAs. We focus on developing financial plans and investment policies that match those financial plans, but we also provide consultations on a variety of issues such as retirement planning, social security planning, college planning. So if you want to learn more, feel free to reach out to myself or anyone else in our team, or consider visiting our website. Next slide, please. So in terms of our presentation today, of course, the main focus is on long-term care planning, but we wanted to spend a little bit of time in the beginning talking about some of the most important considerations when you work on your overall financial or retirement plan. And I tend to use the words interchangeably. So let's say you already have a plan in place, or perhaps you're thinking about developing one. Well, one of the most important questions is, of course, well, how secure your plan really is. And unless you have a clear understanding of your income and expenses in retirement, it would be challenging for you to address that question. Next slide, please, Natalie. So there are many popular rules of thumb that perhaps some of you or many of you know, and we tend to use them for our discussion purposes. But in many cases, they're not appropriate and sometimes even dangerous for planning purposes, especially when we're doing it for 20, 30, or more years. So one of the most researched rules of thumb is the 4% rule. And essentially the way it works, well, let's say you're 65 years old, let's say you have $1 million portfolio, and you want to make sure that you do not run out of money for 30 years. So according to this rule, you would take out 4% out of your portfolio each year. Then each year you would also adjust it for inflation, and it would be a pretty significant adjustment for 2020, with the objective of not running out again by age 95 or in 30 years. It is actually very well documented. There's lots of research behind it. There are a couple of issues with it. One of the issues is it doesn't adjust for your actual tax situation. So if you have different types of accounts, there's no adjustment for that. And perhaps more importantly, in times of significant market volatility, like we experienced in March of last year, well, what are the chances that you would be comfortable with taking out those flat dollar amounts out of your portfolio? So not everyone can actually follow it. Now, the idea that you take 100, subtract your age from it, and then the difference, is presumably supposed to be your allocation to stocks, really has no basis behind it. And I'll tell you, I've been doing, similar webinars for several years now. And before, I usually check if they come up with any backup. There's actually none. Just someone came up with this rule of thumb, and some people are following it at this point. There's so many issues with it. The first one is, well, let's say you're again 60 years old, you take 100, subtract your age, 40% is supposed to be in stocks. What if you're not retiring for the next 10, 15 years? Why would you keep so much of your portfolio in something that is not earning you all that much? So we really rarely use it. There's plenty of conventional wisdom. And what I mean by saying that, a lot of it is actually well documented. When you look at different magazines and they tell you how much you're supposed to have for different areas, such as our area, the DMV area, or you go to different states, there's definitely some basis for it. But again, it doesn't necessarily adjust for your specific circumstances. So what's a better way of approaching this? Well, a better way is to run a retirement projection for yourself that is based on your specific expenses, your specific risk tolerance, your specific sources of income, and of course, it needs to be tax affected. There are two ways of doing this. There's the top-down approach, when you essentially start with everything you have, your assets, your income, of course, your expenses. You would look at different variables such as your projected rate of return, your projected inflation, with the goal of figuring out how much you should expect to have, let's say between your age 65 and 95. And by the way, we would normally plan at least to age 95 unless our clients tell us otherwise. Once you have that number, you would compare it to your projected expenses. And if you're comfortable, well, perhaps this projection will become the basis for your financial plan. If not, you dig deeper. A different way of doing it is the bottom-up approach. Usually we would use it when we're planning, meaning someone is going to retire 10, maybe 15 years down the road. That's when you set a particular target. Let's say I want to maintain a lifestyle of 10,000 in retirement. What needs to happen for me to achieve that lifestyle? Now, what is important is that once you come up with a comfortable scenario, you stress test your own assumptions. What happens if the year of your retirement, the market is down by 30%? That is no longer hypothetical because that's exactly what happened last year. We had several clients actually who retired last year. Next thing they know, well, the market is down, and it's a great thing actually that they had a plan in place. And of course, the idea of having a plan to cover your long-term care expenses, for many of our clients, it's a must. And we strongly recommend that they assess, again, their long-term care needs. I'm not going to say much more about it because, again, Natalie and Rona have much more to say about it. Next slide, please. So once you develop a plan for yourself, usually the next step is to make sure that your investment strategy or your investment policy matches that plan. So some of the key ideas here, well, your overall asset allocation, essentially the split between your stocks and bonds, is responsible for up to 90% of your long-term performance results. So I strongly suggest that you spend a good amount of time making sure that it's appropriate for you. Now, in terms of diversification, and I very much hope everyone understands the idea of not keeping all of your eggs in one basket. But what happens frequently, and actually we worked with a client like that last week, so he had multiple accounts at different brokerages, different investment firms. We consolidated all of that. It was like 10 to 12 different accounts. And what we figured is that most of his investments were the same, and some of them were actually identical. They were just by different providers. So even though there are lots of funds in place, his overall diversification was actually very limited. Now, the idea of considering your risk appetite or your risk tolerance in the context of your longevity, that is important. Again, in terms of your risk tolerance, usually there's a questionnaire, we'd have a conversation. Most people do not struggle with that too much. They know if they want to be more conservative or more aggressive. Now, what happens, as an example, if we work with someone who wants to invest conservatively but expects to live for the next 30 to 40 years? What is the probability that he or she will run out of money if, again, they invest that conservatively? So we need to address that again in the context of their longevity, and there will be some examples later. Of course, your age and inheritance considerations are important factors. We do have clients who essentially prefer to spend it all. They don't necessarily want to leave anything for the next generation, and that's fine. And we do have clients who absolutely want to preserve a portion of their estate for the next generation. And that is, again, when long-term care planning and long-term care insurance can be very helpful. So as the bottom line, in terms of our approach, it is goals-based or goal-oriented. Asset allocation is how we like to refer to it, and it's based on our cash flow-based approach. And I will give you an example of that in just a moment. Next slide, please. So in terms of your portfolio performance, so what you're looking at here is three different models. We have a conservative model that has only 20% in stocks and 80% in bonds. We have a balanced allocation, essentially 50-50, 50% stocks, 50% bonds. And we have a growth allocation, 70% stocks, 30% bonds, and short-term investments. In terms of the performance results over the past, it's a little less than 100 years, really long-term performance results. Hopefully there are no surprises. You would expect the growth-oriented allocation to outperform the other two. Now, again, back to that example, today in 2021, if someone wants to invest ultra-conservatively, meaning predominantly in bonds, would it be realistic for this person to expect to achieve a rate of return of 6%, knowing that current yields are somewhere 1 to 2%, and inflation is above 5. So again, we have to be very careful to make sure that the plan that we develop actually has a good probability of success, especially in the long run. Next slide, please. All right. So in terms of the, here's the poll. I will take a very short break here. Please answer that question if you want CE credit. All right, so here's a simplified, but this is an actual example of how we would do it. So we have a client that has a portfolio of $800,000. Throughout our planning process, we determined that she needs $7,000 per month to maintain her lifestyle in retirement. Yes. She is also a former government employee, so she has a pension and Social Security income, and that will net her roughly $3,000 per month. So in terms of simulating her paycheck, which is usually our approach, she would need $4,000 from her portfolio for life. So we determined that. Now, the next step is to take $4,000 per month, multiplied by 12 to annualize it. This is how much you would need per year, and then multiplied by 7. Now, what is so special about 7 years? That happens to be an average business cycle in the United States, meaning if/when there is a recession, on average, it takes 7 years for the markets to fully recover, on average. Now, over the past 3 cycles, it only took 4.5 years, but we do prefer to be more conservative, so we want to provide that protection for 7 years. So in this case, it would be $336,000 in bonds. We would then take that figure divided by the total portfolio value, gives us 42% in fixed income or in bonds. That would be our initial suggested allocation. Would have a conversation with the client, see if she has any preferences, in terms of her risk tolerance, any other preferences. We would adjust it based on the market conditions. So in today's markets, we would most likely prefer to have less in bonds versus more. But the bottom line here, this approach is objective. It's based on the actual cash needs of this particular client. We're not just basing it on any kinds of rules of thumb, or our subjective opinions. And of course, the end goal here is to mostly isolate, the simulated paychecks from the market volatility over the next 7 years. Next slide. So as a very brief summary, again, we'll have a webinar dedicated to pre and post-retirement planning on November 2nd. If you decide that you need a financial plan, and I would say most people would benefit from that, I would strongly recommend that you base it on your specific circumstances, not different rules of thumb. Your investment allocation is extremely important, meaning the split between stocks and bonds. So when you decide what it should be, consider using the cash flow based approach. We believe it's the most objective way of doing it. And then finally, in terms of your projections or in terms of your planning, usually would suggest multiple scenario to really evaluate your situation. Your base case scenario is something that you're comfortable with. We would then stress test it and have a conversation. How would different variables impact your plan? And of course, the idea of long-term care expenses. If/when you have those types of expenses, how would that affect your overall plan? And with that, Natalie, Rona, what do you have for us?
Yes, hi. My name is Rona Loshak, and Natalie will be presenting after I will. And we really are so happy that you're joining us here today to understand really why and how the mass affluent and high net worth benefit from long-term care planning. Let me just tell you briefly, it's very important to understand, I know you gave a bio, but I do want to emphasize the fact that Natalie and I are licensed nationally and work in all 50 states with advisors in all 50 states and consumers in all 50 states. We've been written up in the Wall Street Journal over 6 times. So we do have a national focus comparing all the different plans across all the different states. And so that's, very important, obviously, for everyone to know as far as working with every plan. So today's agenda, we're going to go through pretty quickly, just, for time's sake. So kind of going to speed through it. But we're really going to be talking about the idea that there's financial and non-financial reasons why long-term care planning is important for high net worth and mass affluent. And we really want to get to the focus of why this discussion is important in a comprehensive financial plan when you are talking to the mass affluent, where many years ago, 20 years ago, it said, oh, if you had a certain amount of money. Now you realize there are so many dynamics in play that have changed over 20, 30 years of why this is an important discussion. Longevity, family dynamics have changed. Government programs have been cut back drastically. The real true cost of self-funding, because these costs have gone through the roof. And then Natalie will be going over the planning solutions in today's marketplace. But you really can't get to the planning solutions unless you understand the why. So let's get to the fact that we're all living longer lives. In the US, once a person reaches age 85, the average life expectancy, 65, excuse me, the average life expectancy is 85. Once a person reaches age 80, there's an 80% chance they'll need long-term care in their lives. That's a pretty high probability. So I know Alex said if, but we're all kind of living longer lives, and most of us at some point will. So as we age, what happens? We're likely to be living alone and might need some help. We're more likely to develop a chronic fall or develop a chronic condition. We more likely will be on a reduced income, and that's kind of relative as far as your cash flow concerned. Even if you had a high cash flow before, your income will probably most likely be reduced when you retire. It's very important to keep in mind that women live 5 years longer than men, most likely to get Alzheimer's, 10 times greater chance of reaching age 85, and are more likely to be living alone. So why do affluent Americans live longer? Basically, their longer life expectancy is due to medical advances and healthier lifestyles. So because they can afford all this, it's a blessing that they're living a longer life, but we have to prepare for that. In fact, in 2029, 1 out of 2 spouses will be expected to live to age 95. And as Alex said, we're creating a retirement portfolio out into your mid to late 90s. So really, longevity requires a new thinking. Why is there this longevity? What's going on? It's really because mortality has changed because of advances. You used to hear breast cancer, heart attack, stroke. Now those are all down. The consequences, remember, people used to buy life insurance in their 30s, 40s, 50s to protect against having, God forbid, one of these conditions. Well, those risks have gone down where the risk of longevity, where Alzheimer's has increased. So it's important to understand where those risks are now based on what's going on. In fact, if you look at an article that appeared in the Wall Street Journal in June of 2021, baby boomers' biggest financial risk is cognitive decline. So just think about that. That's huge, really something important. They control most of the retirement assets now. So as we move forward, let's just talk about how would you feel if you know all this? You know that we're living a longer life. You know that health is changing, and you didn't do something about it. Now we're trying to make you aware that this is something that should be top of mind. What happens if without proper planning for extended care? Basically, long-term care is your largest unfunded risk to your entire portfolio that you've built up. It creates cash flow issues because you might have assets, but that cash flow might have changed. And this is really important because most people who have a certain lifestyle, nothing's really discretionary at that point. Are they selling the second house? Are they not giving gifts to the grandchildren? Extended care is really a threat to your capital. It also means a loss of independence and choice, which people who are mass affluent are used to having independence and choice. They want care where and when they want it. It burdens your spouse, children, ex-spouse, ex-stepchildren, blended families. Once you hear that, you know this usually, even though everybody's all wonderful and everyone's getting along, definitely causes a lot of issue. Everyone's in charge and no one's in charge when there's a long-term care event. It creates wealth transfer conflicts, and it pressures multi-generational family legacy and lifestyle. What this means is we've heard people say, you know, my parents, they bought me designer bags, they took us on trips, but they didn't buy long-term care insurance. They didn't plan for long-term care. Now it's on me and my 2 siblings. And you know what? We're saving for our own child's college and our own children's retirement. We're in our 50s now. I didn't think I'd have to worry about them. We lived a beautiful life together. So again, you've done everything you can for your children. This is the best gift that you could give them. as they move on. So really, long-term care is a family issue. Caregiving results in difficult decisions. People have multiple, they might have 3 kids with different needs and different ideas of how they want to care for you. Your spouse will be older or frail. Your 79-year-old wife, it used to be your 79-year-old wife. Now your 89-year-old wife might not be able to care for the husband who's 92. They just physically can't do it. Solo aging is very, very important to think about. Most of us will be solo agers, especially women. And so having a long-term care insurance policy ensures that you could get the kind of cash flow that you need to get the care that you need, since there won't be children or spouses nearby. Women are more vulnerable. You need to include them in the decision. If you are a financial advisor or any advisor, if that's not typically the person you speak with, or if you're a woman in this audience now, or a male, just make sure that you include the women in your life in this, because they're either going to be the caregiver or the ones receiving care at some point. So let's understand what long-term care is. Many people don't even, we had this question, and it's a fair question. We're so used to saying the word. Long-term care is really where your medical insurance leaves off. Think of it as care is medical insurance. Care is long-term care planning versus cure. Cure is your medical insurance when you have an acute condition that needs to get fixed. Care is when you kind of are not getting fixed, but you just need someone to help you. And how it works is with your activities of daily living. Those are the terms that are used in long-term care. So it basically is help that you need to get through the day, whether you have a physical or cognitive impairment. So long-term care insurance benefits kick in when you need 2 out of the 6 activities of daily living for a condition that would last at least 90 days. The 6 activities of daily living are bathing, dressing, transferring, toileting, continence, and eating. Usually as we age, it's usually the first 3. You might need a little help bathing and dressing or transferring. Very easy to qualify, for 2 out of those 6. And it does not have to be a permanent condition. That trigger is a 7702B, very important. It has a lot of federal guarantees, a lot of tax deductions associated with it. Very important to distinguish that from a 101G, which is a rider sometimes put on life insurance policies. Life insurance policies can have a 7702B, which are these standard triggers, but some of them have a chronic illness rider. And those are kind of the Wild West. There is no standard definitions. Most of them say the condition has to be permanent. So what's important to know is we're going to look at that, and Natalie will get into that further. People who are mass affluent want choice of care. I want to be in a nursing home, said no one ever. If you look at the chart, you see that 18% of care is given in a nursing home. And I would say 99.9% of that is Medicaid. That's where they put you once with home care. When you have choice of care, most people want to be at the home, daycare centers, and in the community. So how much does long-term care cost? Long-term care, basically, if you've been involved in this, these are real numbers. If you're going to be in an average metro area, care is about $32 an hour. And if you wanted round-the-clock care, that's $750 a day. That's after taxes. Okay, that's big money. I don't care how much money you have to be spending that a day, and it could be for years. But let's just do, on average, if you had an 8-hour day, the average cost of care today is about $100,000 a year. The average time care is needed is about 3 years. So we're talking $300,000 today. In 15 years, it's $600,000. In 30 years, we're talking $1.2 million a person, or $2.4 a couple. Again, take these numbers seriously, just like you took the growth in college tuition seriously years ago. So how are we going to pay for this? There is no government program for long-term care now. Some of the states are actually trying to institute something where there's a payroll tax of 0.58% on your payroll, Washington State in particular, to get a very, very minimal plan. Most people who had any assets or income went and got private insurance so they could opt out of that state-run plan. So the people that went for it, a really adverse selection for a small benefit. So we can't depend on the government regarding that. We cannot depend on Medicare, Medicare supplements, or health insurance. Medicare is for skilled care. It's for your doctor's visits, your hospitals. Somebody asked this question. Medicare does not pay for long-term care. You must need skilled nursing care, and only then it approves for 20 to 25 days. If you have a skilled nurse there for 20 to 25 days, they might help a little, but most long-term care on average is required for 3.9 years and Alzheimer's 6 years. So what about Medicaid? I don't know. People say my grandma was on Medicaid, and she got round-the-clock care. That has gone out the window. That was Medicaid years ago. Medicaid now is a managed program. We could do a whole presentation on this, or really an elder care attorney should. The key points are here if you want to look at the recording. The key point that I want to say, 2 key points. It's more expensive for somebody who has assets and income to go on Medicaid than to not go on Medicaid, based on the taxes, the cost basis. We're not even going to go into that because of time, but I do want to point out that there are 2 triggers for Medicaid. One is the financial trigger, you made yourself poor. The other one is the medical trigger. The medical trigger is at a much higher level than long-term care insurance. So we have seen people who got burned, who did Medicaid planning, gave all their money away, and because now Medicaid is requiring 3, 4 activities of daily living, which is what the state plan in Washington is doing, people are not even getting the services that they want to get, and they thought they planned for it. So having a private insurance plan is much better than the government plans. So what if you decided you wanted to self-fund instead of buy insurance? Well, there's a few different ways to do it. Natalie's going to be getting into the detail of those. Let's say we had a standalone plan. This standalone plan, you pay as you go. We have an annual premium of $3,000. We put that away, and in 20 years, you could see the second column, we have $91,000. But if I had bought in the third column a long-term care insurance policy, you would see from day one, I would have a tax-free pool of money of $450,000. And because there's built-in inflation protection in the plans, I would have $812,000 tax-free for my long-term care. The leverage is there and much closer to the care cost numbers that we showed earlier. Now let's say we wanted to try one of the hybrid plans. And we said, well, I'm going to self-fund my long-term care. So if you look at the left, client puts away $127,000. If 20 years of long-term care is needed, they put this into their safe fund, maybe with a treasury bill or something, it grew to $208,000. But let's say they put in something and got double that, they got $400,000. If they needed long-term care, they would have to pull that out and pay taxes on that. Okay. In addition, that $400,000 isn't even close to the kinds of numbers they're going to need for long-term care. So let's say they shifted over their money to an asset-based long-term care policy. If you look at the right, they reposition that $127,000. Initially, from day one, they have $540,000 tax-free from day one. In 20 years, because of the inflation protection, they would have $783,000 tax-free for long-term care. If they never needed it, they would have a death benefit of $187,000, or if they changed their mind during any point, they could take out $127,000 of what they put in. So again, talking about emphasizing again, cost of care, $82,000. If you're going to pull it out of a retirement account, you'd have to pull out $126,000 to get to that $82,000. With long-term care insurance, $82,000 is $82,000. And that makes a huge difference for the mass affluent and high net worth. So let's talk about self-funding. This is a whole, I'm going to just go through this, talking, if you want to just advance that to the next slide. Basically, the cost of care that we had, we're assuming is $435,000. If I was going to pull money out of an account because I need to pay taxes, I'd have to pay $580,000 I'd have to pull out, $580,000. And then what about that? What that $580,000 could have made for my family, especially if I have a spouse? $91,000 in lost appreciation. So that's an additional $671,000. So really, my cost of care was an additional $236,000. So my total cost of care wound up being $672 instead of $435 because I had to pull it out of a retirement account. So for every dollar's worth of care I got, I spent $1.54 of my own money, versus if I went to a long-term care insurance plan. This is a plan where I paid $3,200 a year. In 20 years, my pool of money would be $732,000. I paid $64,000 in premiums, and we get that no one likes to write a check. But if you look at that, my cost of care was $435. I paid $64,000. For every dollar's worth of care I got, I paid 15 cents of my own money. Okay, so if you look, which makes more sense, transferring the risk for 15 cents or self-funding? Basically 90% more expensive to self-fund your care costs. So who should be having these discussions? Really thinking about this. Women are the most vulnerable because they live longer and are likely to be solo agers. Please, please get involved with them. Those people who want access to a private pool of money, entitling them to choice of private care in any setting. Very, very important. You will see assisted living facilities and all the residents there are part of the same country club that they all belong to. Okay, so if you have money, you want to be there. You want to be able to afford the $10,000, $12,000, $13,000 that it is today to be there. Those who don't want to burden your children. You might live on a modest income, but you did the 529, you put your kids through professional school. You don't want to burden them again after doing all that and having them be caregivers. Those with blended families, huge issues. There's so many ways to solve for that, where we give the benefit, the death benefit to the initial first children, all things like that. If you are planning on getting divorced, somebody's getting divorced, get your long-term care insurance beforehand so you're considered married. You still will get the divorce, you still will get the marital discount. Reasonably healthy individuals. You always want to preserve your window as good health, as Natalie will talk about. If you have family history, I don't care if you're 30 years old now or 25 years old, you better look into it right away. The carriers are looking into it, looking into family history, declining some with family history. If you have an uninsurable spouse, they have a condition, you must get long-term care insurance. That spouse will be using up retirement assets because they will not be able to qualify to get insurance, and obviously they might have a condition that will use up your assets. Really, anyone in their 30s to age 85 should be looking into this. Now Natalie is going to be talking about all the different ways you can solve for your long-term care planning.
Thank you, Rona, for the why of long-term care insurance planning, and welcome everybody. So we can see that longevity is giving us an opportunity to plan. Decisions today will affect the financial and non-financial impact to lifestyle, family, and independence. So let's look at what it means to consider long-term care planning. Long-term care underwriting is a function of age and health. And to get a seat at the table, it is not just a want and need conversation, but really a want and qualify conversation. So you can see that the chart is showing you the declination rates across the industry. It's a very, very high percentage of decline, 40% overall or declined. So from the lens of an underwriter, they are not looking at mortality, which is how we write life insurance, but rather morbidity, long-term diseases of aging, chronic aging. So if 40% is a very unwelcome figure. If you work with a specialist, we can reduce that easily in half. And again, looking at a comprehensive set of solutions will give you an even greater chance of success, because you really want to look at what the sweet spots are between and among carriers. So each carrier has a sweet spot for health conditions, but again, it's important to apply when you have conditions that are stable or resolved. So the million-dollar question is, which plan is right for me, and which plan is best? There really is no best. The best is really it's completely dependent on your age, your health, and we optimize going forward. It's very much an art and science, and that is, again, developed on your primary denominator, age, medications, health history, and certainly marital status. It's gender specific today. We want to compare and contrast state residence. In the case that we have multi-states, we'll look between and among those carriers, and ultimately solve for lifestyle and budget. So from the myriad of plans that are available today in the marketplace, again, let's take a look at those individually so we can have some context. The industry grew up in the 70s on what we call standalone or traditional long-term care. I would liken this to a term policy. We still get a tremendous bang for the buck with standalone or traditional long-term care. We've got a lot of flexibility in the way we design premium, meaning premiums can be designed with daily benefits that range from $100 to $500 a day. We can use shared care and innovative riders where we can have 2 shared pools, perhaps 3 shared pools. You will see generous tax incentives from both state and federal government. So again, standalone, a lot of bang for the buck here, including state partnership plans. But more importantly, a lot of flexibility in how these plans are designed with inflation riders, COLAs, shared care. So still remains opportunistic and the biggest bang for the buck. Now, the industry has grown up to be very responsive to the way consumers want to purchase it. So unlike the traditional standalone, which is a use it or lose it concept, asset-based gives you, if you will, your money back. So what does that mean? That means we build this on a little bit of death benefit and a lot or a big extension of long-term care. So if you need long-term care, you've got a very large LTC bucket. If you never used it and were part of the Lucky Club, your money comes back in the form of death benefit. Again, federal triggers in the 7702B language, lots of ways to grow these pools of money with inflation or COLA riders. And what clients love is that you do not pay this for the life of the policy, but rather they're limited pay premiums, anywhere from 1 to 10 years. So 3 years, 5 years, 10 years, depending on how clients like to design. This is an ideal repositioning tool. So if you reposition money from a safe or dormant money or conservative money, it's a really nice way to get leverage. If you've got cash value in life insurance or an annuity, it's a fantastic 1035 idea. But what you really are getting is a little bit of death benefit, a lot of LTC for a total highly leveraged LTC bucket. And again, if you don't use the long-term care, you have a return of essentially the premium coming back to you as a death benefit. In contrast to asset-based hybrids, there's life with riders. So we see a lot of confusion here. I'd like to simplify by telling you life with riders is basically building a big death benefit and then having a rider that allows you to draw through the death benefit or accelerate it. So as an example, if we create a death benefit of $500K and say, gee, I'd like to accelerate $500K at 2% a month, you can pull out $10,000 a month in long-term care benefits. When you do that, you're drawing down the death benefit, pari passu with the death benefit dollar, the LTC benefits will come out and reduce the other values. This can be, again, structured to be very specific. We can do continuous pay, limited pay designs. There are a number of different chassis. So if somebody wanted a whole life policy that they can accelerate, a joint second to die policy that they can accelerate, GUL, UL, there's lots of ways to use life with riders. So again, you're accelerating through the money instead of extending the money. The important distinction when we're talking about life with riders, because this comes up a lot, is that we really must distinguish between a true rider, which is 7702B, and a chronic illness rider. Rona spoke about this earlier, but the 101G is the wild, wild west. We do not have uniform language. We do not have standard regulations. So we do not have a one-to-one spend down necessarily. And for example, we may see non-guaranteed death benefits. So the death benefit could have run out at age 83. The client is now 87. They want to accelerate through their death benefit for LTC. And then we discover it wasn't a guaranteed death benefit and there's nothing to accelerate. So chronic illness riders have got to be looked at very, very carefully. Ideally, we want to try for an LTC rider if we have the health to be able to merit that kind of policy. Annuities with long-term care are another way to solve. This is a really elegant solution for those who may have impaired risk, for those who want to do a joint annuity with LTC, highly leveraged money, a fantastic way, again, repositioning tool. So you solve for, frankly, a lifetime worth of LTC. So we like this a lot. You could also use qualified money. So there's some really nifty, nifty ways to solve here. So when we're looking at sort of good, better, best, it really is in the eye of the client, and that is dictated by the goals. Like what is the objective? Are we primarily wanting to solve for long-term care? Do we want to solve for long-term care with a little bit of death benefit, or the other way around? So traditional long-term care, we still are big fans of using traditional long-term care. Biggest bang for the buck, again, tax incentive. Asset-based LTC is a really sexy way to have your cake and eat it too. We like to call these live, die, or change your mind. If you live, you have highly leveraged money for long-term care, a death benefit if you don't use it, and there's a return of premium feature in these policies as well. So everything is guaranteed. Life with riders or chronic illness riders, again, you're primarily solving for death benefit. And annuities for LTC is an unlimited lifetime income stream, and we can do that sort of on a joint chassis for clients who may want to offset some impaired risk. So which design is best for your needs? This is really speaking to what the needs are. Are you retiring internationally? Does a shared care plan speak to you? What kind of pool do we want to solve for? It's really important when you're looking at a good, better, best to look at each chassis very transparently. So you want to compare between and among designs. So I like to use metaphors. So here's a 2-door car, a 4-door car, and an SUV. So for the same benefit design, what do things cost, and really where are the sweet spots? So again, it's really critical to look at a comprehensive set of solutions so you can make confident decisions. We talked about the government incentivizing consumers to take action, and here we have lots of examples for those who own businesses. So if you are a business owner, rich incentives, regardless of income, regardless of income. What we have here on the chart are what we refer to as age-banded allowable premiums. So if you're a business owner and you are married and you're in your 60s, you can each deduct $45.20 on your as a business deduction, and again that will flow through on your income taxes. So there's a lot that we can do on the federal side, specifically for standalone long-term care, for use in asset-based life when we've got separate and identifiable premiums. There are state-specific credits and deductions as well, and I took a look yesterday just to get up to date on the Maryland tax credit. It's a one-time tax credit of up to $500. There's been a lot of effort to try to allow that credit to be claimed every taxable year. It's been introduced. There was a bill, HB 609. They have not been successful at having that ongoing incentive. So right now it's a one-time $500 tax credit, and there are some specific deductions in the state for business owners. Happy to share that with you as well. If you're a C Corp, you can deduct the 100%, and anybody who has an HSA plan through their employer, this is sort of a triple tax-free gift. You can use your HSA dollars to offset qualified long-term care premiums. So really valuable incentives to help you write those checks. Again, more financing incentives that were given to us through the Pension Protection Act. 1035 is a fantastic way to reposition cash value that may not be used, that are sitting in life insurance or annuities. So if you've got an annuity and you haven't annuitized it, an ideal way to reposition. Same for life. QLACs, obviously, for somebody with impaired risk. Single premium immediate annuity. We use this a lot in the case of divorce, where somebody wants to set it and forget it. Putting a SPIA in place, funding that single premium immediate annuity to pay a lifetime of LTC premium. So again, lots of ways to finance very efficiently because the government is saying, Mr. and Mrs. Consumer, we want you to take action and we're going to help you make those checks easier to write. For those who are planning,
excuse me, Natalie, I just want to interrupt one moment to just let everyone know that the final poll of the session has been launched. If you've responded to any less than 3 polls and you're interested in CPE, please respond to the poll. I'll keep this up for another 10 or 12 seconds. Thank you.
Should I continue, Joe?
Yeah, absolutely. Go ahead.
Okay. Very quickly, I know everybody is racing to do estate planning now with the impending legislation, but for those who have ILETs or want to use ILETs in estate planning, several carriers will let you have third-party ownership and will allow you to use some what we call cash or indemnity products in an ILET. So these are fantastic tools, and I'm happy to have an in-depth conversation, show you white papers and what you need to do in terms of collateralized loan, defensible interest to get these things done. You can carve out, you can discriminate. So for business owners who want to give gifts to their highly valued employees, you can carve out and give long-term care insurance and write off that premium. Again, I would encourage you, if you do this, use a corporate resolution. We have sample documents if that is a consideration. What about the uninsurable? There are alternative solutions. Again, when we are looking at joint policies, joint whole life or joint annuities, we're blending age and we're blending health. So these are contracts that are worth considering. QLACs we mentioned, there are critical illness policies, et cetera, et cetera. Lot of regulations and safeguards in place to help consumers feel confident. I'll highlight 2 of them. In 1996, we had federal standard language. So when do policies trigger? When do I get my benefits? That's really important. Under the belly of each contract, much like we have SIPC and FDIC insurance on banking and brokerage, we have state guarantee associations under the belly of these contracts. And more recently, in the last several years, rate stability acts have been introduced so that we have a lot of confidence on those traditional standalone policies. The older policies, what we refer to as legacy policies, have repriced because they were 30 years old, they guessed wrong, they had a lot of actuarial assumptions. Now we have claims data. And so those rate stabilization models essentially say that those policies are priced fairly. And should you see a rate increase going forward, they will be approximately 10 to 15% of the premium. Most importantly, the carriers that are committed to this space have consolidated, but we have fantastic solutions in traditional, and that's where we saw a lot of consolidation, and where we see a tremendous amount of growth is on those asset-based life with hybrids, long-term life with riders. From conversation to contract, this is essentially 12 weeks for those who are highly motivated. A lot of time spent pre-qualifying for health because you want to get it right. Looking at a set of solutions that are customized for clients, a big education and transparency on the design, helping clients apply. At the time of application, you are simply saying to the carrier, will you give me an offer? Then we refine, get it right, and tailor, and then certainly contracts are delivered. So I would say quarter one, quarter one you start, quarter 2 you deliver. And again, the message is really tongue in cheek, but we really do believe nobody wants to be a nurse and nobody wants to be a purse. and that longevity requires new thinking and proactive planning, a lot of leverage in using long-term care insurance solutions. And with that, I want to make sure we leave time for questions. So we implore you to consider planning, consider your lifestyle, and we are happy to be a resource to help you achieve those goals. And thank you for the opportunity to share with you a lot of information in a short amount of time.
Well, thank you. Thank you, Natalie. Thank you, Rona.